Alright, so check this. If you've ever been confused or conflicted about which credit score is good or which credit score is right, this one is for you. So today I'm basically going to explain. I get the question all the time, which credit score is the right one? I see this credit score online, but then I go get my credit pulled and it's completely something different. It's 50 points higher, 50 points lower. Normally it's the case or the problem. So the short, quick answer to which credit score is correct is the one your lender pulls. The wherever you going to borrow the money, the funds, the whatever, wherever you going to borrow from, the correct credit score is the one that they're gonna pull. Long story short, so today I want to kind of talk to you about whatever this is. That Texas Roadhouse is probably my little. Anywho, the things I want to talk to you about, the things that nobody really tells you or explains to you about your credit score. So your credit score basically is based on estimated risk, and each company or each lender or borrower or creditor is gonna calculate this differently. So basically, when you go to them and you show them your phone or you show them, your credit score from here, there, what they're thinking is, I don't know them people. I don't know where that came from. And it's not saying that you made it up or that the document's forged. It's just saying, okay, well, if they score this differently than we do, it doesn't matter how they calculate your score. Like, that don't have nothing to do with me, basically. So the benefits of having a good credit score are loan approvals, obviously. If you got a credit score, it's easier to get approved in theory. So that goes for mortgages, auto loan approvals, credit card approvals. Your interest rates are better the higher your score. So that I could say is true. I don't know any instances where it's not true. The higher your credit score, the lower your interest rate is going to be. Wherever you go, whatever you do, whatever you're borrowing for, that's going to be the case. Having a higher credit score also increases your negotiating power. So that means when you go in to borrow for a vehicle and they give you the estimated car payment for borrowing the money for that vehicle, when they give you the payment, maybe they gave you the payment to borrow the money for 48 months. Well, that might be their normal term for the vehicle with that amount of miles on it. But if you have really good credit score, they might say, okay, we're going to get paid from what it looks like on this credit report. We'll go 60 months for you just so we can keep you and keep the loan. So it gives you negotiating power, and that I can't say personally with mortgages because I've never done a mortgage loan. So, but I can say with personal auto credit cards, it gives you a little bit of negotiating power. Maybe not so much with credit cards, but auto loans definitely. Personal loans a little bit. Mostly auto loans, as far as like your term, how long you're gonna borrow the money or pay it back. Um, because sometimes they shorten that due to the mileage on the vehicle. But anywho, one more thing, employment considerations. It's easier to get a job in certain places when you have a better credit score. My career path has always been that. Well, not always, but when I got my real estate license in South Carolina, they checked my credit, and of course in the banking industry as working for a credit union, they pull my credit before I've been employed. And I have seen at least, well, I don't know who they were, but I know of at least four people through the application process who were not hired because of that. So it is important, especially in specific industries. So watch out for that too. Um, so let's see. I got a little bit of notes here because I'll go on and rant, and I can't be down here for like forever tonight. We had a long day and got the kids. It's 9:52. But anyway, one of the first mistakes that people make that I noticed is ignoring the impact of old accounts on your credit report. And the length of history is one of the factors that go into calculating your credit score. So closing credit cards is not good in most cases. Even if you don't want to use them anymore, you can call them and you can let them know, but you don't want to close the account. You can let them know there might not be any activity. Don't do that, actually. Just don't use the card. Put the card up, but don't close the account, okay? A second thing is just understanding how utilization affects your credit score. Now, I'm going to go over the 5 factors that go into your credit score at the end, but real quick, utilization affects your score, especially when it comes to credit card balance and limits. If you have a credit limit of $1,000, you want to keep that utilization at 30%, which would be $300 balance, or even lower at 10% if you can. That will help improve your credit score. The third thing that I want to talk to you about today is only checking one credit score. So there's plenty scores. Like I said, y'all, it's all about estimating risk when you're asking to borrow money as far as the lender is looking and concerned. So you have to understand that there's a lot of different models, a lot of different scores. So you're going to have to use a mix of tools to get a really, really good idea of what's really going on. You got Vantage scores, which is basically an average or some calculation of all 3 of the bureaus, Experian, TransUnion, and Equifax. Then you have a FICO score, and even in FICO, you have FICO 5, FICO 3. So it's really hard to try to guesstimate your score when you go in there based on, Credit Karma or what your bank says in their app, because you don't know what you're getting. It might be in the fine print. You might be able to find which one it is. It might say Vantage 5.0. And then even if you take that to your lender and they say that they pull in this model, the score model is Vantage 5.0, they're still going to have to pull it because they have to get it into their software and into their application so they can put it into consideration with everything else in your application. So, speaking of your credit report, so you can get your credit report at annualcreditreport.com, and I would definitely suggest everybody do that. It's free. You should go ahead and get on there. Make sure that when you view each report, they all come separately. When Equifax comes up and you can see it, make sure you download it before you go to the next report. I don't know the order, but one by one, download them as you see them, or you won't see them again. So once you do have all 3 reports, you want to make sure that you fix any errors on your credit report. You want to make sure that you freeze your credit report. Some people will suggest credit monitoring. I'm not sure if I personally have seen the value in it, because you can always freeze your report for free. Now, if you've had fraud in the past, you're concerned about any fraud like that you see forthcoming, possibly. Now, I would suggest credit monitoring then, but at this point, just freeze your credit at all 3 bureaus. You can go on their websites. I can put a link in the comments or the description if y'all want. Just let me know. And you also want to analyze your credit report. You want to analyze your credit report based on the factors that actually impact your credit score. So real quick, there's 5 factors. There's payment history, which is going to be 35% of your credit. The factor that impacts your credit score. So that's going to be paying your bills on time. That's the biggest factor. Pay your bills on time. The more recent the late payment is, the worse your credit score is going to look at the moment. The second is credit utilization. We talked about that a little bit earlier. So you want to utilize 30% of your lines of credit or your credit cards when possible. 10% is best, but 30% will get you a good score. Length of credit history. Don't close any credit card accounts. Some lenders will call that an in-file date, and that's just a date where you just got credit. You just reported on the books. So sometimes they'll go straight to look at that. Sometimes they'll just look at the age of your accounts. Well, they're going to look at that too, but yeah. New credit is 10%. I don't know if I said length of history was 15%. New credit is 10%. So the new accounts that you have, 10% of that goes into your score. And then last, types of credit, 10%. So you have lines of credit, revolving credit, which basically means you borrow some, you pay it back. You borrow some, you pay it back, and you up to a certain amount. And then you have installment loans, which are you borrow a set amount, then you make a set payment each month until the amount is paid in full. So the type of credit also matters. There are also 5 C's of credit, which are very important. And I want to make another video about this because this goes into creative lending, and that's kind of one of my favorite things. Character, your character. How long have you been on your job? How long have you been at your current residence? How long have you had, not how long, because that's a whole nother thing, but character, just your person based on what they see on your credit report. Everything's not your credit score. Your credit score is going to determine what interest rate you get, but just because you have a 650 score doesn't mean you're approved. That's your score, but they want to see, okay, so what went into that? Maybe you got one credit card you've had for 3 months and a personal loan you've had for 6. You're still pretty new. Like, you're not quite ready for a mortgage. So character, we're looking at all that. Capital, we may ask you to bring in your statements that shows how much you have on hand in your accounts everywhere, not just with us. If you have an account with us and you're borrowing from us, if you have funds outside of here, we would like to see proof of that. We want to know that you have capital, things that are assets and, could help you overcome in a time where, something happened and you still need to make these payments. Collateral. So this is when you have a secured loan or a loan that's secured by something, normally a vehicle. It could be cash that is on hold, and or a house if it's a mortgage. So collateral is pretty important as well. So you may be qualified or pre-qualified for a certain amount to purchase a vehicle, but then you bring that vehicle in and it's got too many miles, or it's more than 10 years old, or it's not worth what the purchase price is, what the asking price is. In the event of a house, same thing. The seller is asking for $200,000 and an appraiser goes out there and he says it's only worth $150,000. The bank is not going to give you anything but $150,000 because that's all that the official person or the appraisal said. That's not a good investment for them. So, collateral is definitely important when it comes to secured loans. Then you got capacity. So capacity is mostly determined by your debt to income ratio. A lot of the times you're going to want that to be 50% or lower. Hopefully 45% or lower is where you really want to be. And that just means that if it's 50%, if you got $100 a month coming in, just make it easy. You got $50 a month or less going out. So we just want to see that you can pay that loan back. You're not overstretched. Yeah. And then you got conditions, and those are the terms of the loan. So earlier I talked about negotiating power. So let's just say you have a 600 credit score and you find a vehicle that is 10 years old. So it's a little bit on the older side. So you already got the collateral against you. Your DTI looks good. Your capital looks good. But now you want the payment, because this vehicle's for your son, you want the payment at $250 a month. And that would mean that the vehicle would have to be financed for 84 months. Now, if this was a brand new vehicle and everything else said yes, you might be good. But if you got a couple of different things, not checked off, and a couple other boxes not checked, it might be hard. So basically conditions, the only thing that really, let me see, you could change the terms of the loan. You might change the down payment. So you might only put down, 3.5% instead of 10%. You might only, the conditions or the terms of the loan are the last C. Because I don't want to go on too long. I'm already about to hit 5 minutes, but y'all let me know. Let me know if it was helpful in the comments. Just let me know. I have a worksheet. And then it's like a credit cheat sheet. And I have the links to where you can freeze your credit. I've got annualcreditreport.com there, a couple other things. So if you want it on paper, just in the comments, let me know. But I'm going to go ahead and get out of here. I will be right back tomorrow with another video.